What's good, everybody? Welcome into another edition of Market Takes, a very special edition of Market Takes. We are, of course, breaking down the Consumer Price Index report that just came out at 8:30 this morning. But of course, Market Takes isn't just about looking at the data. Market Takes is about analyzing the data. And we can't do that without talking about what's going on with Silicon Valley Bank, some of these bank runs that we're seeing out here, and just we're going to dive all the way into what's happening with the overall economy. So we're going to talk through all of that right here on Market Takes. I'm your host, Dion Rabowen, reporter for the Wall Street Journal. We are going to dive all the way into it. Look, we're going to talk about what the CPI report said. We're going to assess the state of the economy and the markets. Like I said, talk a little bit about these bank issues that we're seeing. We're going to check in on the markets as well, because we know markets tell us a lot about what's going on and how investors perceive that and what can happen next. And of course, we're going to explain what today's report tells us about the future, because we are always looking forward, even though it's backwards looking data. And we're going to talk about the big picture, what comes next. So listen, without any further ado, let's dive all the way into the CPI report. The report showed that in February, inflation rose at a 6% year-over-year pace. The core inflation rose at 5.5%, and month over month rose about 0.4%. So you see this chart that's up there on your screen. Now, I wanted to put this up here to just show the overall pace of inflation, the way that it's risen and the way that it's come back down in recent months. So you see that peak up there, the highest bar you see, that's in June. That's when CPI inflation rose to 9%. We have come back down to about 6%. What does that tell you? Well, as Charles Schwab chief fixed income strategist Kathy Jones tells us, inflation is, quote, trending lower but still high. That 6% still way above what we were at even in the early days of 2020 before the COVID pandemic, and we are still very high. The Fed wants to get us down to 2%. That's close to some of those levels you see on the other side of your screen. As you can see, we are very far from that. So just wanted to put that up there to kind of illustrate where we've been, where we've come from, where we are, and kind of why the market is expecting what it's expecting for the future. Now, this report came in a little bit below expectations. The expectation among economists surveyed by Dow Jones were for 6.1% year-over-year inflation and 0.5% month over month. So we were just a tad below that, but inflation overall coming in doing what it was expected to do. But we know it's not just about what the headline number is, right? We're conscientious market watchers. We know it's not just about the headline numbers that's going to move those plebes over there who aren't really watching the market. We know it's all about context. So we're going to dive into what a little bit of that context means. Real quick thing I want to point out from a line from the BLS's CPI report. Quote, "The index for shelter was the largest contributor to the monthly all items increase, accounting for over 70% of the increase. It was also 60% of the core increase. Core is when you strip out volatile food and energy prices from the reading. So shelter, aka housing, aka what you're paying for rent, what you're paying for your mortgage, all those things, that was accounting for 70% of the overall increase in CPI. Now, why does that matter? Well, not only does it mean that prices for rent and housing and shelter are increasing, which we've known for a while, but the Fed Chair Jerome Powell has come out and said, look, our real-time indicators are showing us that rent prices are going down, that shelter prices are going down, that overall people are paying less money for where they live. So if the shelter index is taking up 70% or accounts for 70% of the increase, well, that tells you that maybe inflation actually isn't that big of work. We know this is a lagging indicator. We know it takes a while for the actual price of housing to get factored into the report. Even when housing is starting to move in an opposite direction, it can take a while for that to get factored in. The Bureau of Labor Statistics has told me that personally, and they really don't have a good explanation for why or how long it takes or a way to really account for that. So we know that there is this delayed metric that is keeping inflation higher than it otherwise would be, or keeping CPI inflation higher than it otherwise would be. That's good news for investors who are looking for maybe the Fed to pump the brakes a little bit to stop its hiking cycle. So we know these things, and we've seen this report that suggests that maybe, okay, even though inflation, according to CPI, is still 6%, it could actually be lower than that. Also, a little bit of good news, want to make sure I don't miss this. In contrast to the overall food index, the meats, poultry, fish, and eggs index fell 0.1% over the month. I know y'all have been going crazy about eggs. Egg prices actually fell down. The index for eggs fell 6.7% in February, following sharp increases in recent months, according to BLS. That's some good news. So maybe we can go out and get eggs again soon, get them omelets going. I know it's been a while for me since I had an omelet. Those egg prices have been crazy. I want to get into the other piece of bad news, though, for this report. And again, we got to dive into the context. The core services X shelter, aka super core, and remember, Fed Chair Jerome Powell said super core is what they're watching. That was up 0.427%, aka 0.4% or 0.43% versus 0.265% last month. What does that mean? The index that the Federal Reserve has honed in on, that Fed Chair Jerome Powell said, hey, this is the most important thing we're watching, that rose and rose by a lot more than it did the previous month. So what we're seeing is services, things like going to your lawyer, things like buying a trip, a plane ticket, going to see your chiropractor. All those things are rising in price, and they're rising at a pretty significant pace and picking up pace, not slowing down. So that's why we have seen, I think, a lot of the reaction that we've seen from the bond market. We'll get into that in just a little bit. I talked about this. We did a big report, WSJ.com, about what is super core inflation. If you're not familiar, make sure you check that out. We're going to link to it in the comments or in the video description, so be sure and check that out. That increased a lot more. We saw that in recreation, that it was up 0.9%, household furnishings and operations up 0.8%, airline fares up 6.4% year over year, ending a string of 4 consecutive declines. That's big. Also, index for motor vehicle insurance increased. So this puts the Fed in a little bit of a bind because they've been saying super core, super core, super core, but they also might want to pause here. They also might want to say, hey, we've got this banking fiasco going on. Well, maybe we need to pause what we're doing. That's what a lot of folks out there are saying. Barclays, Goldman Sachs, among the big names saying the Fed's going to pause at its monthly meeting, not hike 50 basis points as had previously been expected, but hike 0 basis points, not move this month, let things settle down. It's going to be harder for them to do that when you've got the super core inflation, the measure that they have spotlighted and said, this is what we're watching. That's increasing and increasing at a faster pace than it was last month. So let's take another step back here. Pause all this talk about CPI because inflation is important to the overall narrative, of course. It also plays a big role in this bank narrative that we're seeing, right? These bank runs, the collapse and the failure of Silicon Valley Bank, of Signature Bank, the second and third largest bank failures in the history of the United States. One quick thing I want to throw up here to illustrate what we're talking about in terms of trouble in the banking sector. This is the KBW Bank ETF. It's the NASDAQ Bank Index. Basically, all the biggest banks in the US are in this ETF. If you don't know what an ETF is, it's just a collection of a bunch of different stock prices put together that make one stock index or one exchange-traded fund. This is Citigroup, JP Morgan, Wells, PNC, Bank of America, Huntington Beach, Comerica, all really the biggest banks out there, and you can see just falling off the cliff. They're down about 20% in just the last few days. This index is down about 15% year to date. It's down 18% in the past 5 days. That is a huge decline, and you're seeing some of these troubles in the banking sector. So just wanted to throw up there that chart to illustrate that this is not just one bank. This is across the board. The banking sector is in trouble. There's some worries about contagion. I'm going to talk about why some of those may be founded and why they may be a little bit unfounded. So let's first talk about Silicon Valley Bank. Biggest bank failure since the global financial crisis. $209 billion in total assets, $175 billion in deposits as of December 2022. The country's 16th largest overall bank. The Federal Reserve stepped in, declared it systemically important, and was able to create a new fund to make sure all those depositors were made whole, as well as Signature Bank. That would have been the next largest, or the third largest, or that was the third largest bank failure in the history of the U.S. So I want to break down why that happened and why that could have effects on the overall banking sector, the overall economy, and why it may not. Why it's something you might need to worry about, why it's something you might not. So let's simplify. Let's say instead of 202 billion, 209 billion, excuse me. Instead of 209 billion in deposits, let's say Silicon Valley had $100 billion in deposits. And let's say they had 10 depositors. Again, just to keep this simple, these are not the real numbers. We're going to simplify this. Now, if this bank, Silicon Valley, had $100 billion in deposits, they're not keeping $100 billion in a safe somewhere at the bank. No. They're investing a lot of this money. They're using that to make loans. They're only keeping around, let's call it $10 billion for simplicity's sake. The Federal Reserve actually lowered banks' reserve requirement ratio to 0 in March 2020 and has not raised it back up since. So technically they could just be keeping about $35, $40 million if they wanted to. But for the sake of this example, let's say they're keeping $10 billion. Let's say they only have 10 clients, right? So each client has $10 billion. Well, banks are investing this money. For Silicon Valley Bank, it was a lot of treasuries, a lot of mortgage-backed securities, a lot of stuff that is pretty safe, a lot of things that, folks in the banking sector, the Federal Reserve says you should invest in this, not into meme stocks and things like that. Banks invest in a lot of different things. Part of this is mortgages as well. That was a big part of Silicon Valley banks. All of those things are losing value. Bonds losing value, stocks losing value, mortgages losing value, commodities losing value. If you put money in something a year ago, in March 2022, it is likely to be worth less now. And so the problem is that these banks had this money in deposits, they took it out of the deposits, they invested it, and now that money is worth less than the amount of deposits they have. So they had $100 billion in assets. Let's say for simplicity's sake, they had a diversified portfolio that is now down 20%. Well, now they only have $80 billion and they have $100 billion worth of liabilities, as in what they have to pay if everyone in the bank came to demand their money. So what's been happening recently? Silicon Valley was very reliant on the venture capital industry. Venture capital, a lot of startups, a lot of tech, that's been hit very hard, and you've seen folks kind of fleeing the space. You're seeing a lot of these companies burning through cash, which means they're not bringing money in, but they still got to pay. They got to pay for headcount. They got to pay suppliers. They got to pay to keep the lights on. They got to pay for their rent. So that money has just been getting pulled out by depositors a lot faster than money has been going in. At the same time, a lot of these companies, you've got the unemployment rate really staying low, but a lot of folks being laid off. These tech layoffs that you've heard, folks are scared, they're worried. So again, they're pulling out cash, they're having to spend that. As that same thing is happening, you are seeing that Silicon Valley Bank's investments are declining. So they've only got this, let's say, $80 billion. And now let's say one client says, hey, you know what? Listen, I need my $10 billion back. Things aren't looking so good. I'm having to pay a lot of money over here. I'm just going to need my $10 billion back in cash. Silicon Valley, they don't want to do it, but they have to do it because they owe that money. That's the client's money. They have to give it to them. So now all of a sudden, Silicon Valley has $0 in cash, and they've got $80 billion invested that should be $100 billion. Well, now they've got to figure out, okay, we've got to either sell some of these things that we've got at a loss, take the loss on our books, and have less money overall. And one of the things that Silicon Valley Bank did is they put this in a special category called hold to maturity, which means they didn't have to mark down the losses they were taking on because they planned to hold the bonds until they matured. As in, when you have a bond, you buy it, you basically give a loan to whoever is selling the bond. You say, okay, I will buy your bonds, US government in the case of treasuries, and then you get all that money back plus some interest. But the problem is a lot of Silicon Valley's assets were held at a duration of 10 years. So Silicon Valley's borrowing, they expect to get paid back in 10 years or more, and they're saying we're going to hold this thing so we don't even need to mark down the losses because we're never going to take any losses because this thing will be worth exactly what we paid for it and we're going to make money in 10 years. Well, if you got to sell it before 10 years because you've got to get money, you've got to get cash to your clients, you've got to get money back so you have some available, that means you got to sell it at a loss. What they did instead was they tried to sell stock to raise money to meet some of these cash flow issues, and Moody's Investor Service, the ratings agency, caught wind of this. They said, oh, no, we see your losses, we see your cash position, we see that a lot of people are pulling money out of your bank, we are going to downgrade you. Well, when that downgrade came, there were some folks watching out anyway. They said, hold on, wait a second. VC industry in trouble, tech in trouble, markets in trouble, their investments in trouble. We should pull our money out. So now more people are pulling money out of the bank. And so instead of that first client who pulled his $10 million out, or her $10 billion out, excuse me, now another client comes in and says, hey, I've heard about this. My financial advisor says I need to get my $10 billion out. Now another client says, I need to get my $10 billion out. Well, now you've lost 3 clients. You've had to pay $30 billion out. Your portfolio is down about 20%. So you've got less money available, and now you're going to have to sell more things. Well, you don't have that money. you don't have the money to meet all the liabilities or all the clients that you have. You don't have their money anymore. Their money has lost value. You try to do the stock sale, you couldn't, you wanted to do another one, but you can't because the market's gonna punish you. Your stock price is plummeting, so you can't even issue more stock. And that's how we end up in a bank run with a failure of the second largest bank, or the second largest bank failure in US history. That's why we got there. Now, here's why that's worrisome. First of all, lots of banks behave this way. You've got lots of banks. This is typical bank behavior. Taking deposits from customers and using them to buy assets and securities. That has been typical bank behavior for quite some time. The Glass-Steagall Act, remember, that was done away with in deregulation. Oh, we don't want regulation, that's bad. Get rid of Glass-Steagall, which keeps banks from investing deposits. Okay, now they can invest deposits, they can make loans on those. Remember, housing prices are going down. We're seeing mortgage values decline. So basically anywhere you'd put your money, you're seeing lower valuation for that. And this low reserve ratio requirement for banks means that they don't need to keep a lot of money around. And in fact, a lot of them have been keeping very close to minimum levels of cash on the books. The reserve ratio requirement is zero. The reserve requirement ratio is zero. They only have to keep, I think it's $36 million on hand, and they want to use that other money to make money. They want to invest. The same way if someone gave you some money, you'd say, hey, I can invest this in treasuries, get 4 or 5%. I can invest in stocks and earn some money on that money because you're basically getting it for free, and now you can go make some money with it. So that's why we're seeing this as worrisome, because other folks are looking at some of these other banks, especially these regional banks. Things like First Republic, we've seen their stock get hit really hard. Also Zion's Bank, Pacific West, Western Alliance, all these other banks that are sort of mid-tier regional banks that have a lot of deposits that are higher than $250,000 and that have invested a lot and have seen losses on their portfolio. Folks think the big guys are pretty safe because they've got a ton of cash deposits. About half of all the money deposited at FDIC insured banks is at 5 banks. The big 5, JP Morgan, Citi, US Bank, Wells Fargo. I'm forgetting one, but forgive me. The great news about too big to fail institutions is that they have a lot of cash. They're very safe. The bad news is a lot of these other banks that are not too big to fail, they have a lot less cash. So let's also talk about why this isn't worrisome. And that gets to why we may not see a bank run throughout the whole system. First of all, the Federal Reserve has stepped in, set up a new facility with $25 billion of capital. They say the discount window is still open. Banks, if you need cash, we got you. They've come out and really kind of solidified that and said, we're going to be doing more here. The Fed also flooded the system with money. Look, the Federal Reserve can create money out of thin air. They pump it into the economy. They can get it to these banks. Banking sector has a lot more regulations in terms of how much capital they need to hold, but a lot of what they have to hold instead of cash is these treasury bonds that have been losing value. Again, a big bank can take on those treasuries and there's not really a big risk for them when they take that on because they know we've got enough cash to pay out these depositors, we're all good. So the big banks not doing so well. This is great news for bank safety. It's not such great news for consumer choice, and that's why there's a lot of worry about what this could mean, but that's also why when it comes to a systemic failure of the banking system or issues in the overall banking system, well, people aren't quite as worried. Let's really quick check in with markets right now. Just want to talk through what we're seeing across the board in markets. Stocks are up big. We're seeing a really big reaction to the CPI report, or maybe just to it not being yesterday or it not being Friday with all these bank failures. You're seeing the NASDAQ up about 1.8%, the S&P up about 1.6%. I think that's very interesting in the way it contrasts what we're seeing in the bond market. We are seeing yields up big time at the short end of the curve. Now, when I'm talking about the 1-year Treasury bill is up 38 basis points right now, the 2-year is up about 36 basis points now. What does that mean? Those are expectations for Fed rate hikes. That means the market sees the Fed doing more after this CPI report, and I think that goes back to that super core number that we talked about, up about 0.43% after being up about 0.26% last month. Investors in the bond market are much more closely watching the economy, much more closely watching developments like this super core and like this CPI report than stock investors are. And I think that's why you're seeing this divergence. Now, both treasury yields are up, which means bond prices are down, and stock prices are up in a big way right now. And I think that has a lot to do with the way the market is interpreting this CPI report. When we talk through and we look at currencies, we're seeing the dollar a little bit higher, about 0.2%. Again, that means when you're seeing those yields rise, you're seeing the dollar, but you're not seeing a big move in those 10-year, 30-year yields. Those have been very little moved by this report. Euro is up about 0.1%. The dollar is up big against the Japanese yen. Definitely keep your eye on that. We look out at those commodities. Oil down about 1%. It's making a recovery. Gold down about 0.3%. Natural gas down about 2.25%. Natural gas has been a big loser for a while. Call your energy company and ask them why they're charging you more for your bills while natural gas is at the lowest price it's been in about 15, 20 years. Take that from me. As market takes news you can use. We're going to talk through a little bit about how this relates back to overall inflation. Listen, what inflation means is that when inflation is high, the Fed raises rates to try and cool it down. If we see inflation hold up, that's what causes those things like treasury bills to rise, like mortgage rates to rise. And that has been hitting the value of these mortgage bonds. So a lot of these issues are related directly to what we're seeing in the banking industry. Banks are investors, they invest the money, and when the markets are losing because the Federal Reserve is raising rates, that creates an issue for a lot of these banks. And if you see inflation persist, you could see a lot of these issues for the banks persist. I want to take one more look at inflation and just kind of contextualize and illustrate what we're seeing overall with CPI and what we have seen for a while. So you look back there at January 2020, what did we see? So when inflation really, March 2020 is when the COVID pandemic first hit the US. You saw CPI inflation dive, and then you see it kind of start to pick up noticeably and then really just ratchet higher. Well, what happened? We got the CARES Act, $3 trillion of stimulus. You got the Trump stimulus, the Trump lame duck stimulus at the end of 2020. You got the American Rescue Package from President Joe Biden, and that's where you start to see those inflation numbers really pick up. But don't forget, March 2020 was when the Fed started QE infinity. That's when they said, we are going to buy as many bonds as necessary. We're going to do whatever it takes. And you really see the money supply just explode. And you saw, so businesses have lots of money from the Fed. You've got low borrowing rates. They loaded up on a lot of debt. Now the money is starting to run out. Now, investors are betting that this inflation is going to go away by the end of the year, 2023. But as you can see up there on your screen, we are still at 6%. So just wanted to throw that up there to illustrate the kind of trend for inflation that we've seen. I just put a video out yesterday on the page. Check it out. It's about what's happening with delinquencies. And we have seen this huge buildup and pickup in credit and people taking on more credit card debt and more debt overall. And now we're starting to see delinquencies pick up. Definitely check that out if you haven't. Hey, listen, that's going to really wrap it up for us here on Market Takes. This report really tells us that inflation is still an issue. It's a bigger issue and that the Fed is going to have some choices to make. Do they focus on price stability or do they focus on financial stability? And that's going to be the big question when they meet March 21st and March 22nd. We will be right here on March 22nd. That's next Wednesday, talking through the Fed decision, the outcome, the statement, all that good stuff, and what Fed Chair Jerome Powell has to say. But before that, tomorrow is going to be another exciting day on the market. Retail sales is out. We'll be breaking it down right here on Market Takes. I hope you'll be there. Don't be a... That's going to do it for us here on Market Takes. Thanks so much for joining us. I'm Dion Rabone, reporter with the Wall Street Journal. We'll see you next time.